Welcome back, everybody, to the Deep Dive today. We're going to be looking at something that's really important but often overlooked, and that is the psychology of money.
Yeah,
So we're diving deep into Morgan Housel's book, The Psychology of Money, to really try and understand why our minds and money
right.
sometimes just don't seem to mix very well.
That's right. We're going to kind of unpack why understanding this psychological side of money is so critical for making smarter financial choices,
Right.
regardless of how much or how little you might earn.
And this isn't just about, the numbers and budgets and spreadsheets.
Right.
Housel makes a point that really resonated with me. He says that no one is crazy when it comes to money.
Yeah,
It's about understanding why people's seemingly irrational financial decisions actually make perfect sense within their own unique experiences.
absolutely. I think about those late night infomercials that promise you riches.
Right.
To some, it might seem ridiculous, but for someone who feels financially trapped, that glimmer of hope can be incredibly powerful.
It's total sense. So let's dive into one of Hauser's first big ideas from the book, and that is the power of personal history. So he argues that everyone's financial decisions are shaped by their own experiences,
Right.
forming these unique mental models about how money works.
Yeah.
So what exactly are mental models and why are they so important?
You can think about mental models as these personalized lenses through which we view the world of money.
Okay.
And all of our upbringing, our cultural background, even pivotal moments of success or struggle,
Uh-huh.
they all shape these models.
So someone who grew up during a recession might have a completely different view
Totally.
of risk and debt than someone who experienced, a booming economy in their early years.
Exactly. And their mental models are completely different based on those experiences.
Right.
And they'll interpret financial information and make decisions in different ways.
To illustrate this point, Housel uses this fascinating example. He talks about lottery ticket buyers. He points out that in America, people spend more on lottery tickets than on movies, video games, music, sporting events, and books combined.
Yeah, and even more intriguingly, the majority of those tickets are purchased by those in lower income brackets.
Now that seems counterintuitive.
Yeah.
Why would people who can least afford it spend so much on something with such low odds of winning?
And that's where understanding those individual mental models comes in.
Okay.
So for someone living paycheck to paycheck, saving might seem impossible. Upward mobility feels out of reach.
Right.
But that tiny chance of winning the lottery represents this tangible dream, this glimmer of hope for a better life.
Yeah, it's not even really about the money itself then.
Right.
It's about what that money represents.
Absolutely.
A chance to break free from those financial constraints to access opportunities that seem otherwise out of reach.
Precisely. Their mental model, shaped by their experience of financial scarcity,
Right.
makes that lottery ticket a rational purchase, even if it's not financially sound in an objective sense.
It's a powerful example of how our past can actually really influence our present financial decisions, even when those decisions seem completely illogical to other people.
Right. And it's not just our individual experiences that shape these models, but Housel also talks about how major historical events like the Great Depression have profoundly impacted how entire generations view money.
Yeah.
Like those who lived through it experienced devastation on a scale we can hardly imagine.
Right.
And it instilled in them this deep aversion to debt and risk-taking that continues to influence their financial decisions even decades later.
Yeah, I can see how that experience would have a lasting impact,
Right.
making them much more cautious with their finances.
Exactly. Their mental models are imprinted with these memories of financial hardship.
Right.
So their attitudes towards saving, spending, and investing are completely different than someone who grew up during economic prosperity.
This idea that everyone is essentially playing the game with a different set of rules based on their personal and collective history is incredibly eye-opening.
It is, and it
Yeah.
underscores why judging someone's financial decisions without understanding that mental model can be really misleading and harmful.
So, okay, listeners, before we dive further into this fascinating world of mental models, let's pause for a moment and ask ourselves, what are some key events in your own life or even in the lives of your parents or grandparents that might have shaped your own views on money?
Yeah.
It's a powerful exercise in self-awareness that can help us make better financial choices.
And on that note, let's move on to another fascinating concept from the book, and that's this idea of enough.
This is something that resonates with a lot of people, I think.
Yeah.
We live in a world that constantly pushes us to want more, achieve more, accumulate more.
Yeah.
But when is it enough?
That's the million-dollar question, isn't it?
Yeah.
And Housel argues that getting wealthy and staying wealthy
Right.
are two distinct skills
Okay.
and often require very different mindsets and strategies.
Give us an example from the book that illustrates this difference.
He shares this great anecdote about John Bogle, the founder of Vanguard.
Okay.
And he recounts a story about authors Kurt Vonnegut and Joseph Heller attending a party hosted by this billionaire hedge fund manager.
Okay. This is good. I like where this is going.
And so Vonnegut points out to Heller that their host made more money in a single day than Heller had earned from his wildly successful novel Catch-22 over its entire history.
Ouch.
And you would think
Yeah.
that that would sting a bit,
Right.
but Heller responds with this brilliant line, "Yes, but I have something he will never have. Enough."
Ooh, that's good.
Right.
What a statement.
And so Housel uses this to highlight that the relentless pursuit of more can become a trap,
Right.
even for those who have already achieved immense wealth.
Yeah.
It's the difference between playing to win and playing not to lose. You know, getting wealthy might require ambition, risk-taking, a hunger for success. But staying wealthy requires contentment, humility, and the ability to recognize when you have enough.
So it's not just about reaching that certain financial milestone,
Right.
but finding satisfaction and fulfillment in what you've already achieved.
Exactly. And this concept of enough applies to everyone regardless of their income level. It's about defining your own personal goals and finding a balance between striving for more and appreciating what you already have.
This is such a crucial point, especially today, where we are constantly bombarded with these messages about acquiring more, achieving more,
Yeah.
never settling.
Yeah, you get caught up in that cycle.
Yeah.
But Housel reminds us that true wealth lies in having the freedom to live a life aligned with our values, not chasing an ever-shifting definition of success.
It's about taking control of your own narrative,
Absolutely.
defining what success really means to you, and aligning those financial goals with your values.
Precisely. And speaking of the dangers of chasing more, Housel shares a cautionary tale about Rajat Gupta.
Okay.
This is a man who rose from humble beginnings to become the CEO of McKinsey.
Wow, that's incredible.
Yeah, the world's most prestigious consulting firm.
Yeah.
And despite achieving immense success, he had a net worth estimated at $100 million. Gupta got caught up in the pursuit of more and engaged in insider trading,
Right.
sharing confidential information that allowed a hedge fund manager to make millions from illegal trades.
Wow. So he risked everything.
He did.
For what? Just to have a little bit more.
It highlights this slippery slope of never enough. Even at the pinnacle of his career with wealth and prestige,
Yeah.
he fell victim to this allure of wanting more, ultimately jeopardizing everything he had built.
This story underscores the importance of really defining your own version of success.
Absolutely.
And finding contentment within those boundaries.
Yeah.
It's a reminder that true wealth is not just about accumulating money, but about making choices that align with your values and protect what you've already achieved.
Right.
And this leads perfectly into our next topic.
Okay.
How this often misunderstood concept of compounding plays a role in financial success.
Yeah. All right. So when we talk about compounding, most people think about, that thing that makes their savings grow in a bank account.
Right.
But Morgan Housel really encourages us to think bigger.
Okay, so it's not just about watching those pennies slowly turn into dollars.
Exactly. It's about understanding the exponential nature of growth, which our brains just often fail to grasp.
Okay, so give us an example. Paint a picture for us. What's a story from the book that brings this idea to life?
Well, he does this really brilliant comparison between Warren Buffett, the legendary investor,
Right.
and Jim Simons, the head of this hedge fund Renaissance Technologies.
Okay, so Buffett, obviously a household name, but I'm a little less familiar with Simons. What makes him so special?
Simons has achieved something pretty remarkable. He's compounded money at an average rate of 66% annually since 1988.
Okay.
That's phenomenal, even compared to Buffett's impressive 22% annual return.
Wait, so 66 versus 22. So Simons is blowing him out of the water. Why isn't he richer than Buffett then?
And that's the catch. That's where the power of compounding really comes in.
Yeah.
Simons didn't start seriously investing until he was 50. So that's less than half the time to let those returns compound compared to Buffett, who has been investing consistently since he was a child.
Ah, so even though Simons has these amazing returns, Buffett's longevity in the game has given him a massive edge.
Precisely.
Kind of like the tortoise and the hare situation.
Exactly. And so Housel even takes it a step further, and he does this little thought experiment.
Okay.
He calculates what Simons' net worth would be if he had earned those 66% returns for the same 70-year span as Buffett.
Okay, drum roll, please. What's the number?
Over $63 quintillion.
63 quintillion. I think my calculator just broke trying to figure that out.
It's an astronomical number.
It is.
And it illustrates just how much those seemingly small differences in annual returns, when compounded over a long period, can lead to truly mind-boggling results.
Wow.
And the real secret ingredient here is time.
I think we've all heard the saying, time is money. But this really puts it into perspective. So let's bring this back down to earth for our listeners. How does this concept of compounding play out in our everyday financial decisions?
One of the biggest takeaways is the importance of starting early.
Okay.
Even small amounts saved consistently, especially when you're young, can grow into something significant over time.
Right. That's the classic retirement savings advice. Start early, save consistently. Got it. But Housel also talks about, misconceptions about compounding. What are some of those?
One big one is that compounding is solely about these financial investments we make.
Oh.
He uses this really clever example of the explosive growth of data storage.
Data storage. How does that connect to compounding? Help me wrap my head around this one.
It's all about that exponential growth we were talking about.
Yeah.
Think about how much data we can store on our devices today compared to just a few decades ago. It's astounding.
Right.
In 1956, IBM unveiled the first hard drive, this massive contraction that could store 5 megabytes of data. Fast forward to 2019, we have these tiny devices that can hold 100 terabytes. That's 100 million megabytes.
That's an insane increase.
Right, and it shows how technology, like money, can grow at an accelerating rate that just leaves our linear thinking in the dust.
So compounding applies not just to our investments, but to technology, to innovation, to the way information spreads in our world.
Exactly. He uses these seemingly unrelated examples to expand our understanding of compounding beyond these traditional financial applications.
Mind officially blown.
Good.
What other misconceptions does he address?
Another one is that compounding guarantees riches.
Okay.
It's tempting to think, just start early, be patient, and watch the money roll in.
Right.
But he reminds us that while compounding can generate significant wealth over time, it's not a risk-free endeavor.
Okay.
He emphasizes this critical role of survival, the ability to weather those inevitable setbacks, those market downturns, the unforeseen events that life throws our way.
So starting early and letting compounding do its thing isn't the whole story?
Right. Staying in the game even when things get rough is just as crucial.
Okay.
To illustrate this, he compares Jesse Livermore, this legendary stock trader who made and lost fortunes multiple times,
Right.
to Ronald Read, a humble janitor who quietly amassed a fortune through frugality and long-term investing.
That's a fascinating comparison. What can we learn from these two very different paths?
Well, Livermore, despite his brilliance, was prone to excessive risks, which ultimately led to him losing everything.
Right.
Reed, on the other hand, focused on slow and steady growth, avoided debt, and never interrupted the power of compounding. He lived a modest life, but his patience and discipline allowed him to accumulate significant wealth over time.
This is such a valuable lesson no matter where we are on our financial journeys. Staying in the game, even when it's tempting to, go all in or cash out entirely, is essential to letting compounding work its magic.
Absolutely. Survival is the ultimate financial skill, as Housel says. And he emphasizes the importance of building this solid financial foundation that can weather any storm, whether it's, an unexpected job loss or a sudden market downturn or a personal emergency. This resilience, this ability to stay in the game even when others are forced out,
Right.
is what allows you to seize those opportunities when they arise.
So it's not just about chasing those highest returns,
Right.
but about creating a strategy that can keep you in the game for the long haul.
Precisely. He suggests that building an unbreakable financial foundation is often more important than trying to time the market or pick winning stocks.
Okay.
This might even mean accepting lower returns in some areas, like keeping a portion of your savings in cash or low-risk investments to provide a cushion during uncertain times. That room for error, that ability to absorb losses without being forced out of the game entirely,
Right.
is what allows you to capitalize on those opportunities when they present themselves.
This resonates with me. It's about playing the long game, not getting caught up in those short-term fluctuations or risky gambles.
Exactly. It's not about getting rich quick. It's about building lasting wealth through patience, discipline, and a willingness to embrace the ups and downs of the market.
This ties back to those seemingly small differences in returns that we were talking about earlier.
Right.
I'm starting to see how they become so significant over time.
Absolutely. Those small differences, when compounded over years or even decades, can have a massive impact on your overall wealth.
Right.
But remember, these gains are only possible if you can stay in the game long enough to let compounding do its work.
Okay, before we move on, I want to pick up on something you mentioned earlier, this idea that compounding isn't just about earning more, but also about saving more.
Yes.
This is a big one for our listeners to understand.
Right. He argues that focusing on your savings rate, the percentage of your income that you save, is often more important than trying to earn a higher income, especially as your earnings grow.
That seems counterintuitive.
Yeah.
Wouldn't earning more money automatically lead to greater wealth?
It's a common assumption, but he uses this surprising analogy to illustrate his point, the 1970s oil crisis.
Okay, now I'm really intrigued. How does an oil crisis connect to our personal savings habits?
Well, back then, the world was really worried about running out of oil.
Right.
But instead of just finding more oil, the solution came from becoming more efficient with the oil we already had. We started building more fuel-efficient cars and factories and homes. And this increase in efficiency actually had a much greater impact than simply finding new sources of oil.
So he's drawing a parallel between energy efficiency and financial efficiency.
Exactly.
Okay.
He argues that when it comes to building wealth, focusing on saving more, becoming more efficient with the money you already have, can be more impactful than simply trying to earn more.
It's not just about the inflow, but how much you're able to keep
Precise.
and put to work for you.
He suggests that taking a good hard look at your spending habits, finding areas where you can be more efficient without sacrificing what truly matters to you, can be a really powerful way to boost that savings rate.
This is so relatable. It's not about deprivation.
Right.
It's about making conscious, intentional choices that align with your financial goals.
Exactly. Everyone has areas where they can become more efficient with their spending.
Right.
It might mean cutting back on those unnecessary subscriptions, or finding creative ways to reduce those utility bills, or simply being more mindful of those daily expenses.
Right.
These small adjustments, when combined with the magic of compounding, can make a significant difference.
This is such a practical takeaway for our listeners. It's not about finding a magic formula.
Right.
It's about taking control and making choices that really support your long-term goals.
And this leads perfectly into his next major point, this idea that we aren't always as rational as we think,
Right.
especially when money is involved.
Yeah.
Emotions like fear and greed can easily hijack our best intentions, even when we believe we're making calculated decisions.
I think we've all been there, making those impulse purchases we later regret. Selling investments out of panic, or chasing those hot stock tips that promise those unrealistic returns.
Right. Our emotions, our biases, even our desire to fit in can exert a powerful influence on our financial choices, often leading us down paths we wouldn't take if we were truly thinking rationally.
Okay, this is where it gets really interesting. I'm ready to unpack those irrational impulses that drive our financial behavior.
Right.
What insights does House offer to help us understand this better?
Yeah, it's funny how we often view ourselves as these, rational beings carefully weighing the pros and cons when making decisions.
Right.
But, especially when it comes to money emotions like fear and greed, they can really easily cloud our judgment,
Oh, yeah.
lead us down these impulsive paths we end up regretting.
Absolutely. I've been there myself.
Yeah.
More times than I care to admit, we make those emotional purchases or sell investments when the market dips,
Right.
or chase those hot stock tips that promise quick riches.
Howells uses this really clever analogy to illustrate this point. He talks about how we treat a fever. So for centuries, fever has been seen as this enemy, something to suppress immediately.
Right.
But modern science tells us that fever can actually be beneficial.
Right.
It helps our bodies fight off infections.
So even though we know that fever can be a good thing, we still reach for that medicine cabinet,
Exactly.
trying to bring it down.
We prioritize comfort over what might be best for us in the long run.
Right.
And Housel suggests that we often do the same thing with our finances. We make decisions based on how they make us feel in the moment, even if those choices aren't in our best long-term interests.
So our emotions take the wheel even when we think we're being all rational and logical.
Right. What are some examples of this playing out in the financial world?
Okay, yeah. What are some
What
examples?
else? Housel talks about Harry Markowitz,
Right.
this Nobel Prize-winning economist who literally invented the concept of modern portfolio theory.
So this is the guy, if anyone should be the poster child for rational investing,
Right.
it's him.
But even Markowitz admitted that when it came to investing his own money, he didn't follow his own complex formulas.
Really?
He split his retirement savings equally between stocks and bonds.
Huh. That seems almost too simple for someone who, revolutionized how we think about investing.
Right. He said he wanted to minimize his future regret.
Hmm.
So he imagined, how he would feel if the stock market skyrocketed and he wasn't fully invested,
Right.
or if it crashed and all his money was in stocks.
Yeah.
So he chose that balanced approach to avoid the emotional pain of either scenario.
So even a brilliant economist armed with all these sophisticated tools and models still made decisions based on human emotions.
Mm-hmm.
It's kind of comforting to know that even the experts wrestle with these biases.
It is. And it really underscores Housel's point that understanding our own emotional biases
Right.
is so crucial for making sound financial decisions.
Hmm.
And he encourages us to ask ourselves, what am I trying to avoid feeling?
Okay.
That question can often reveal those hidden motivations behind our choices, helping us make more informed decisions.
That's a fantastic question for all of us to reflect on.
Right.
It's about bringing those subconscious fears and desires to the surface
Yeah,
so we can make more conscious, intentional choices.
absolutely. Housel also talks about how the stories we tell ourselves can impact our decisions.
Okay. Yeah. So we're not just talking about emotions now, but the actual narratives that we create in our minds.
Yeah, he argues that we're constantly crafting these narratives to try and make sense of the world,
Right.
especially when it comes to these complex systems like the economy.
Mm-hmm.
And these narratives often shape our expectations, our risk tolerance, even our belief in certain financial strategies.
So the stories we tell ourselves can actually influence our financial reality.
Mm-hmm.
How does that work?
Imagine an alien observing Earth during the 2008 financial crisis.
Okay.
The alien sees the same buildings, the same people, the same economic activity as before the crisis.
Right.
But something has changed. The story that we're telling ourselves about the economy.
Okay, so the fundamentals haven't changed, but our perception of them has shifted.
Exactly. And once a narrative shifted from, stability and growth to this, fear and uncertainty, the economy really spiraled downward, even though the underlying capacity for wealth creation was still largely intact.
It's fascinating how this collective belief, or the story we tell ourselves,
Right.
can really have such a powerful impact on the economy, almost like a self-fulfilling prophecy.
Right. And it applies to our personal finances as well. Housel encourages us to be mindful of those stories we tell ourselves about money,
Okay.
especially when they're rooted in, fear or scarcity or distrust.
So if I constantly tell myself that I'll never be able to buy a house or retire comfortably,
Right.
that belief might actually prevent me from taking steps to achieve those goals.
It's very possible these negative narratives, they can become self-limiting,
Right.
holding us back from pursuing opportunities or making changes that could improve our well-being.
Like a mental roadblock that prevents us from reaching our full potential.
This is such a powerful point, recognizing the power of our thoughts and beliefs.
Right.
It can be the first step toward changing our financial reality.
Absolutely. And this brings us to another fascinating aspect of money psychology that Housel explores,
Okay.
and that is this allure of pessimism.
Mm.
Why are we so drawn to negativity, especially when it comes to finances?
Well, he argues that it's hardwired into us.
Okay.
Our brains are designed to pay more attention to threats and dangers
Right.
than to, slow and steady progress. It's a survival mechanism that has kept us alive for millennia.
Right.
But in the financial world, it can make us, overly cautious and risk averse.
So we're more likely to fixate on a stock market crash
Right.
than on the, long-term upward trend of the market.
Exactly. Housel uses the example of the Wright brothers.
Okay.
When they first achieved flight, nobody seemed to care.
Right.
It took years for people to really grasp the significance of their invention. But when their first fatal crash occurred, it made headlines around the world.
Wow, yeah. That's such a vivid illustration.
Yeah.
We're just naturally drawn to the dramatic,
Yeah.
the negative, even when it goes against this broader trend of progress and innovation.
And this negativity bias can make us, overly cautious and even cynical about our financial prospects. Housel encourages us to be aware of this bias
Right.
and to balance it with a recognition of those long-term positive trends that are shaping our world.
So it's not about ignoring the risks,
Right.
but about keeping them in perspective
Exact.
and not letting them overshadow,
Yeah.
the potential for growth and progress.
Maintaining that balanced perspective,
Right.
one that acknowledges both the risks and the opportunities, is key to making sound financial decisions.
Okay, that makes a lot of sense.
Mm.
But speaking of historical trends, Housel also cautions against relying too heavily on past data when making financial decisions.
Right.
Why is that?
He calls this the, historians as prophets fallacy. this tendency to assume that the future will perfectly mirror the past.
Right.
And he argues that in a world, constantly shaped by innovation and these unpredictable events relying solely on historical data can be incredibly misleading.
So even though we can analyze past market trends and economic cycles
Yeah,
and investment strategies, there's no guarantee that those patterns will repeat themselves.
exactly. He points out that the world is far too complex and dynamic to be predicted with any certainty based only on what's happened before.
That makes financial planning feel a little daunting.
Right.
If we can't rely on the past as a roadmap, how do we make decisions about the future?
Well, instead of trying to predict the future with perfect accuracy, he suggests that we focus on building flexibility and adaptability into our financial plans.
Okay.
Be prepared for a range of potential outcomes,
Right.
recognizing that the future will likely unfold in ways that we can't fully anticipate.
So it's about having a plan,
Yeah,
but also being willing to adjust that plan as circumstances change.
exactly. This
Yeah.
flexibility, this willingness to embrace uncertainty and adapt to changing conditions.
Right.
This is crucial for navigating the complexities of the financial world.
Okay, I'm starting to feel more empowered than overwhelmed.
Good.
But I'm still curious about, his point about using historical data as a guide. Is there value in studying the past?
Absolutely. He's not suggesting that we completely ignore history.
Right.
Studying the past can help us understand those market cycles and identify potential risks,
Right.
learn from the mistakes of others.
Yeah.
But he cautions against using historical data as this crystal ball,
Right.
assuming that the future will be this carbon copy of the past.
It's about learning from history but not being bound by it.
Exactly. Think of historical data as one piece of the puzzle. But recognize that the future is always being shaped by new innovations, these unexpected events.
Right.
The collective decisions of millions of individuals.
This is such a crucial insight. It's about acknowledging the limitations of our knowledge and being prepared to navigate a future that's full of surprises.
And that brings us to another important concept that he explores, and that is this price of returns. He argues that volatility and uncertainty are inherent parts of investing.
Okay.
And instead of viewing them as these punishments, we should really see them as the cost of admission
Okay.
to participate in the market's potential for growth.
So it's like paying a fee to access a service or experience.
Exactly.
Like paying for a Disneyland ticket.
Precisely. Investors who expect these high returns without any volatility or risk, they're essentially trying to get something for nothing. And Housel suggests that instead of trying to avoid those ups and downs of the market,
Right.
we should embrace them as the price we pay for the potential to grow our wealth over time.
I love that analogy. It really shifts the way we think about those inevitable market fluctuations.
Yeah.
But how do we know if we're paying a fair price? How do we decide if the potential returns are actually worth the risk?
This is where he emphasizes the importance of playing your own game. He argues that, different investors have different time horizons, different risk tolerances, different financial goals.
Right.
What might be a reasonable risk for a young investor with decades to recover from losses could be devastating for someone nearing retirement.
So it's not about following the crowd or chasing the latest hot investment.
Right.
It's about aligning your strategy with your own personal circumstances and goals.
Exactly. He cautions against being swayed by the actions of others, especially those who might be playing a different game than you are. He uses the example of the dot-com bubble,
Okay.
where these short-term traders drove up the prices of tech stocks to these unsustainable levels,
Right.
leading to huge losses for those long-term investors who bought in at the peak.
Yeah, that's a cautionary tale for all of us. It's so easy to get swept up in the excitement.
Yeah.
But it's so crucial to remember that, not all investors have the same goals or timelines.
Define your own investment game based on your individual circumstances and objectives. And stick to your strategy even when it feels like, everyone else is getting rich quick.
Right. This has been an incredibly insightful deep dive. We've explored the power of personal history, the allure of pessimism, the magic of compounding the price of returns, and so much more.
It's been a great conversation.
It really has. And we've seen how understanding the psychology of money can have such a profound impact on our financial decisions, often in ways we don't even realize.
Yeah.
So what's the biggest takeaway for our listeners? What should they be thinking about as they navigate their own financial lives?
I think the most important takeaway from House's book is this. Understanding the psychology of money is just as important as understanding the numbers.
Hmm.
Our emotions, our biases, our beliefs, they play a huge role in shaping our financial behavior,
Right.
often leading us to make choices that might not be in our best long-term interests.
It's not just about what we know, but how we feel
Exactly.
and how those feelings influence our decisions.
Absolutely. And one final thought-provoking idea to leave with your listeners is this end of history illusion.
Hmm.
This is the tendency we all have to underestimate how much will change in the future.
So we tend to look back at our past selves,
Yeah,
see how much we've grown and changed,
right,
but we kind of assume that we've reached this final form in the present.
right. But we're constantly evolving.
Right.
Our goals, our desires, our circumstances, they will likely change in ways we can't even anticipate.
So how does this apply to our financial planning?
It challenges us to build that flexibility and adaptability into our plans.
Hmm.
Ask yourself, what financial decision have I made in the past that I might approach differently now, knowing that I'll likely continue to change and grow?
That's such a great question for all of us to consider.
Right.
It encourages us to embrace the uncertainty of the future
Absolutely.
and to create financial strategies that can really adapt to those inevitable changes.
That's what makes Housel's book so valuable. It's not just about learning new financial strategies.
No.
It's about developing a deeper understanding of ourselves
Mm.
and how our minds work when it comes to money.
This has been a truly eye-opening deep dive.
It has.
And I encourage everyone listening to check out the psychology of money and explore these ideas further. It's not just about becoming wealthier.
Right.
It's about making more informed, more conscious, and more fulfilling choices with our money.
I wholeheartedly agree. By understanding the psychology of money, we can empower ourselves to create financial lives that truly align with our values, our goals, and our evolving sense of self.
Beautifully said. Well, thank you so much for joining us on this journey.
It's been a pleasure.
And we'll be back next time for another deep dive into the world of ideas.